priority is to know what is your variance covariance matrix of your portfolio. Once your variance covariance matrix is ready, then you are ready for anything. So you can almost fly if you are managing your portfolio, or if you are looking at the risk return perspective of your portfolio. So we'll see the two other methods which we are going to use today in Black Litterman approach, and we'll also be using it later on. So these two approaches are very important and widely used because of some reasons which I will discuss when we reach there. So okay, so this first method of another method of doing the various covariance is simple index method or simple index model. So if you remember how we did variance, I think that this was the first thing that we learned is we should have a price matrix, the prices of various stocks about which you want to create variance covariance matrix. So prices we converted into return, market return, by using logarithmic return or exponential weighted return. So once we have the return, then we also created the mean return, and from the return we calculated the deviation from the mean, and then we had a two set of metrics. One is the deviation from the mean. The also other is from deviation from the mean. What we did, we multiplied the transpose of one matrix with the original matrix and divided that by n-1, because that's how the covariance is calculated. So that was simple sample variance covariance method. The problem in that method, this variance the sample variance covariance method, is it relies on historical information. Historical information means like past 5 years it takes into account, or maybe past 2 years it takes into account. And the problem with the history is it may repeat, it may not repeat. So for example, last few days the market has been very volatile. So if you had taken the historical variance covariance matrix, the past 15 days, that would not have worked at all, because correlations would have been very high. All asset returns were running in tandem. So for example, gold was high, nickel was high, oil was high, and market was extremely low. So market was also falling. So in a way, all assets were completely out of sync. So what happens is, in situations like this, or like if you want to do a simple way of calculating variance covariance, so what we do is we apply this simple index model. So this model relies on this formula, that return of any asset equals, like this is basically a regression equation. So return of any asset equals the intercept, which is like the excess return, plus beta times the market return, which is x, which is the independent variable, and the epsilon, which is like the error term. So basically what happens here is, like, we assume that all assets in our portfolio are giving you return in some, sorry, someone is saying something. Yeah, so all asset returns.
Sir, in this equation, you said that the intercept term, like there is intercept term, and then the coefficient associated is with respect to the security, not the market. Is it with respect to the market or the security? In the equation that you were just telling, so there is this beta term with respect to security and not the market. Is it right, or is it with respect to the market?
Yeah, good. So see, when you are regressing, if you know about the regression equation, so when you regress, what you do is, like, you regress your asset return vis-a-vis return of something on which you think that this is dependent. So x is the independent variable, and this Ri is the asset return, which is dependent on x's. Okay, so this Rx here, as you said, the answer to your question, Rx is a market return, not this asset return. Is that clear to you?
Yes, sir.
Yeah. So if we regress, like for example, and anyway, I'm going to demonstrate it to you here in after, like in the subsequently in this slide only. So we are assuming that all asset returns. So for example, if you have ICICI, Infosys, HUL, or TCS, or like Reliance, their return can be modeled on the basis of the Nifty return. So this equation is just talking about this. If this is a fact, then what can be done is the estimated return, which is ERI, can be estimated return. I'm talking, not the actual return, because actual return will vary slightly because of the error factor, and which is also like if you have studied econometrics, you'll realize that some seasonality is there, which is like something not normal. So the expected return is nothing but the excess return plus the beta times the expected return of market. And if this relationship holds, then what happened? The sigma ij, which is the covariance between stock I and stock j, is beta I and beta j sigma x square when I is not equal to j, which will be sigma I square when I exactly equals to j. Means like there are 1 terms, or 2 2 3 3 4 4. Means like if you have 10 by 10 matrix, so all the diagonal matrix will have the variance term, and the other than diagonal matrix will have beta I, beta j, and sigma x square. So with this premise, we calculate simple index model. Now, the simple index model is very simple in the sense that we just need to apply a formula, and it does. Only requirement is you need to have this is programmed in your computer, because you need to program it. So we'll see how it is done. Let me select 10 into 10 array. So I selected 10 into 10 array, and here I write equals SIM. Okay. And then what happens is, in this, first you have to select all the stocks return, because first we are selecting, assuming that stock returns are dependent on market. So first we have to take stock returns into account, and then yeah, so stock return selected, and the next one is the market return, which is GSPC is Goldman Sachs. Okay, so let me give you some brief. The X is Exxon Mobil, MSFT is Microsoft, APL is Apple, General Electric is there, Bank of America is there, Pfizer is there, and Exxon Mobil is there, and this I think X is US Steel or something. So these are the stocks which are all large cap stocks of S&P and 500, and the index is being given by S&P 500 GSPC. So next I will mention about the index, which is L20.
So these are log returns, right?
These are all log returns.
Yeah.
But let me tell you one thing. Even if you are not using log return, here it won't matter much. Why? Because your index return also be the ordinarily compounding return, and your stock returns. So regression, a relationship between them will not change if like you are not using log return in this particular case. But as I told you before, you should be using log return, because that's better representation of the actual return. So this is so in simple index model, what I have written, first written the metrics of this entire stock, and then the last is this the index, which is Goldman Sachs S&P 500. And if I then use Control Shift and Enter, then I get the there is some did I select more? Something I missed. Let me check. So 4, 5, 6, 7, 8, 9, 10. C20. Oh, yeah, I missed here. In my formula, I I missed B actually, which is MCD. So because I missed B, so one of my column and one of my row is missing. So let me do it once again. Just let me delete it, because deleting also is a yeah. Now, again, I will have to write here. Okay. how I use, and here it has given me the this simple index model, variance covariance matrix. So now I've got this simple variance covariance matrix. If you compare this with the previous variance covariance matrix, which is what we did, so this will be very close to that. Of course, there will be slight variation because this is not calculated based on the excess return. So there will be slight variation, but this is how it is to be done. And this is probably the easiest way of doing it, but it's quite reliable and we can use it if we have the market return and stock return rather than going for deviation from that. So this is one way of doing the variance covariance. Now,
Sir, one
yeah.
query. Sir, how
Yeah.
many digits after 0 should we take after point? Like 4 digits?
Okay. So, this all depends on like what kind of data you have and what kind of return you. So, for example, if you are using daily returns will not be daily returns will rarely be more than 1 or 2%, and in some cases, very rare cases, it will be more than 1%. However, if you are taking yearly return, that will be substantial. So accordingly, any from 2 digit to 4 digit will suffice. But what happened in this case, like when I was looking at this, after I calculated the variance covariance, I realized the first 2 digits after decimal, they are almost nothing. So I need to at least go to the third and fourth. So I went to the fourth, but you can go for 5, 6 also, no problem. But I think up till 4, you can have a look and then understand that how good is your data, or like how is your data looking at, how can you make inferences from your data. But however, if this figure was larger, I could have stopped at 3, but that's for is fine, no issue with that. But if it is percentage, I stop at 2 decimal after percentage, because the left one will be the integer and the right one will be the decimal. So that's okay, but nothing. And the best part of Excel is, even if let's say I select this particular thing, and this is looking at 0.0036. However, if I use this data to multiply with any other data, it will not be using 0.0036. It will actually be using the entire value of the cell, which could be 0.003578912. So it takes the actual form, but when you round it off to the nearest decimal, then it comes into that form. So nothing to worry about. Even if you use one digit or 2 digit after decimal, that is still okay if it like you're using in combination or something else. So this is how we do the single index model, and I think I have shared this with you. So all you need to do is to just use this enable the macro and keep using this whenever you need to do the simple index model, and this will be perfectly all right. So yeah,
I have a question.
Yeah.
So 4 methodologies that you would be learning pertaining to calculation of covariance matrix.
Yeah.
Would the results be different for all the 4 methodologies? And if yes, then which one should we use and what is the use case of each of these? Like if I'm using this this one that we have just done, when and where should I be using this one compared to the one that we learned earlier?
Okay, very good question. Actually, this is $1,000,000 question, and that's what is the purpose of the whole learning exercise. So, as I referred to you in the beginning, the normally what happens, variance covariance is nothing but it's all about correlation. It's all about correlation and return. So, if the return of two stocks follow a certain relationship, the variance covariance matrix will depict that relationship. So, for example, just let me show you this. So, this is the covariance of stock 1 with a stock 6. So, stock 6 is K, which is the K is used for I don't know, it is US Steel or something. But anyway, this big some American data. So just excuse my understanding of some of the stocks, the script code. So the stock K is very little correlated with McDonald. Okay. Now I realize now, because McDonald I get reminded. So K is nothing but K log. Okay. So Kellogg and McDonald's are not correlated. So this is what this is showing. Now, if you use the any other method, so this is based on this is based on the relationship between the price of the individual stocks vis-a-vis the Goldman Sachs. So it is assumed herein it is assumed completely that the return of market is a good proxy for modeling the return of individual stocks, which to a large extent is true. And absolutely the difference between the single index model and the variance covariance sample variance covariance model will not be very substantial. So if you use variance covariance sample method or like this sim model, there won't be substantial difference. Why? Because both are almost coming from the same sources. The only thing is, because in sample variance covariance method, you are subtracting from the daily or the monthly return, the average return, and then you are taking the differential, the multiplication of these two value, the differential value of x with y to calculate the covariance, and that's how the matrix will be done. So the answer to your question is the difference between sample variance covariance and sim will not be very substantial, which is not of concern to us. So here it is like this. Now coming to the other method, the second one, which is what we are going to do, is the shrinkage estimator method. There will be substantial difference between shrinkage estimator method and what we have done just now, the simple index model or the sample variance covariance model. Why? Because if like you take 5 years of return, in 5 years of return, you will probably have the different business cycle. So sometimes the market will be in uptrend and stocks will be correlated in a particular way. Sometimes it will be completely different. Why? Because certain stocks will get affected by certain other factors. So for example, the oil related stocks, any stock that has exposure to oil will get heavily affected because of oil price hike. Recently it went to $130, which is all-time high, and people were expecting that probably it could go to 200 also, and if the war continues, it can go. So if historical relationship is not going to hold, then you cannot trust the simple index model or the variance covariance, sample variance covariance. Then you need to tweak it. Yeah.
The file that you shared this morning was actually the one that you did last time. So we have not received the one that you're working with right now. So
No.
Could you just check?
Yeah. So this was sent, but prior to that, because I was hoping that on that day only I would have finished it, but somehow I got it. So this I will just share. Don't worry. This I will share because this is already, if you go here in the developer one, you'll see that the formula is copied. So even if you copy that formula in your macro, that will write. So this I will just share. Don't worry. This is other files I've shared, which is where we are going to start working on. This was something that see, the problem what happens is there are some issues with I think there is some virus issue. Sometimes it doesn't let me edit cells, so that's why I was worried. So I didn't try to paste one with the other because there are always issues with macros. So this I will just send it across to you. What you can do is you can always delete all this, okay, all this, and then do at your own. What you can also do is you can change this data, and you can change this data and see whether the results. So this I'm straight away going to share with you. Yeah. So so what happens, like if the relationship of the history is not going to be repeated, so you are not going to use this sample variance or simple index model. Why? Because you are relying on a slightly longer period of data, and which could have like the historical feature, which as of now may be different. So for example, last 15 or 20 days, market was completely behaving irrationally. Why? Every day the market was falling. There was no reason to expect market to fall. Why? Because India is doing so great. All the Indian businesses are doing well. The purchasing index managers report is coming up well. The quarterly growth is better, but still market was falling. Why? Because globally we are correlated. So there are, in times of stress, you need to estimate your own variance covariance on the basis of something. One of that is shrinkage estimator. So you seem that, okay, no, the history was probably not very kind. It was very high correlation being depicted in history. So we want to reduce it, which is what we'll see in the shrinkage estimator. Some market practitioners also use option pricing, the applied volatility of the option market. Why? Because it is expected that the traders who are using the pricing in the option markets, they're buying or selling call, they have the real information in the market. So the volatility that they are pegging to a certain stock or a certain index or certain put and call option is the real one. So you can also derive your variance covariance matrix on the basis of that. So these are the 5 ways in which it is done. But as you practice and practice and you progress towards your end of understanding the modeling, then you will realize that it's all your own insight which will come into play. So if your own insight is working and you realize that look, this was for example, this Kellogg and McDonald, both of them are in food chain, but still they are not correlated. You know why? Because probably like one may be heavily dependent on like lots of product, the other may be less dependent on lots. So for example, Kellogg is like mostly into the domestic household supplies, like it's you see it's cornflakes, wheat flakes, and the other combination of the oat and all that food products, which is all householders are using. But McDonald's is fast food, which is used by the working people who are on the move and all that. So they are not correlated. It's not correlated, though both of them are in the food industry. So this relationship may hold or may not hold, and depending on your view, for example, if food food products are high overpriced, then maybe the correlation will go high and maybe this relationship will not hold. So the answer to your question is, as you mature, you'll realize that which method is going to hold one. But if you ask me which one I would rely on, so I would rely more on shrinkage estimator in times of looking at my portfolio rebalancing. Why? Because then it gives me some room to understand that okay, this is slightly higher, and I will show you also in the Black Letterman portfolio which we are going to do. I will show you that if you use this sample variance covariance model, then this leads you to very unrealistic portfolio combination. So for example, if I use this simple index single index model, and I construct a portfolio, the chances that the sum of the portfolio will be unrealistic, which we'll see. And if this is on this, how do you take care of this? So we take care of this by using the shrinkage estimator. So we are going to do this. Okay. So let me share the other file, which is shrinkage estimator. Or meanwhile, I will send this to you. Just give me a moment. I will send this to you. So
Sir, I had a query.
yeah.
Sir, won't there will be a case that there will be wrongful correlation? Like we said, that correlation does not mean causality. Like it could mean mathematical anomaly, and we may interpret it wrongly.
Okay. Yeah. So the answer to your question is exactly. So for example, if you see the there is a gentleman called who's Oxford AstraZeneca. He's based in Pune only, right next close to your institute. So like if you see a businessman and talking to your principal or talking to your director, and you derive as that this businessman is going to take over your college. So this is like just one set of things that you are talking about, is that like just a causality or like it's just a coincidence. Now, if you look at all the 5 years of data, or like 10 years of data, or like the 60 months return, or like some 3 years of return, so there this factor is going to be less of an importance. Why? Because one coincidence will not get captured every time. So for example, like out of panic, people start buying and selling, and if you take a daily correlation of one stock with the other, maybe it will be very high. But if you take 3 to 4 years, those the aberrations of a which is what we can call a statistical aberration, which is what like you are taught in the class of statistics, that for example, if someone is if like some celebrity is wearing a particular dress, and this is higher snowfall on those occasions, and if you draw the correlation will be high. But does it make any sense? Answer is no. But if you do it for 60 months and then like something, but again here you know it that it cannot work because this doesn't make any sense. But in case of stock returns, if you have a very large data set, and if it is over a like different business cycle, which is like 10 or 12 years, then that data set is robust and you need not worry about that. So That's what like your concern should be, and those things can be by for example. Yeah, so good that you asked me this question. So the answer to that also is, you should look at, once you have the variance covariance matrix or a correlation matrix, you should look at the figure and ask yourself that whether this correlation is really being caused by something fundamental, or this is just like an aberration, and which, if you look at it, you can realize, if you realize that this is wrong, then you can change it. And this is why, like, you are being taught all these things, so that you develop your self in such a way that tomorrow you can tweak it according to your requirement. So okay, so we go to something called shrinkage estimator method of variance covariance. So can you see this on my screen?
So you are not presenting anything.
Okay, sorry. Actually, that's why I asked you this. Yeah, yeah. Can you see now?
Yes, sir.
Okay. Yeah. So what in this particular case, this is yearly return. As you can see, this is 3rd January 94, then January 95, January 96 to January 2004. So this is the yearly return of 6 stocks, which is General Electric, Microsoft, Johnson, Kellogg, Bank of America, and IBM, which is into computer. And this is their yearly return, which is, like, you can see, it's quite substantial. So like here, if you take a longer digit, it won't make sense, because a smaller digit is sufficient for you to derive some conclusion. So once you have this, the average return is very easy, because I take the averages. Once you have this, then you can take the standard deviation also, and then the variance, as you know, can be calculated. So you have this daily, the yearly return of these 6 stocks. Now, what happens is, if you have to calculate shrinkage estimator, so what you do first is, you calculate the sample variance covariance. So this is 6. So we will have 6 into 6. So we'll select 6 into 6 array. And then here, what I write is, so I will subtract the mean return, because like your and as you can see, we have 11 years of data. So I will have to divide this by 10. And let me check whether the brackets are all right. So yeah, and then now I click Control Shift Enter, and I get this variance covariance. Okay, so this is my variance covariance matrix, which is just like what we talked about, sample variance covariance matrix. Now this okay, so let me write one formula. So the shrinkage estimator works on this formula, that my actual variance covariance matrix is lambda times the sample variance covariance matrix, which is, if I can write here, let me write so that you remember. My God, something is happening. So lambda into this variance covariance plus 1 minus like lambda, so that it is lambda, which is lambda into another matrix. Variance matrix. This is how shrinkage estimator, the shrinkage estimator vector works. So you have to use one shrinkage factor called lambda, which could be anything from 0 to 1. And this is why I was telling you that why we are inclined to use sometimes shrinkage estimator is sometimes historical correlations are higher. Sometimes it could be lower also, but sometimes it's higher. And like if your period is the period of high stress, then it will definitely be very high. For example, during 2008 subprime crisis, all asset class returns were moving in tandem, which is like the worst situation. Why? Because the very fact that we are studying about variance covariance matrix is because we want to understand that which are the stocks to be included in portfolio, so that in times of distress, your one stock is failing miserably, but other is performing super well, which is the beauty of correlation and the covariance. So, but that whenever that relationship is in doubt, so we use this shrinkage estimator, where the shrinkage factor is lambda, which is 0.1, 0.2, 0.3, 0.4, 0.5, any number you can take. So, for example, in this case, we are going to take 0.3, which is we are smoothing it. We are not making it. We are going very conservative. So second thing is, so the one matrix we have calculated is the sample variance covariance. The next is what we are going to do is we are going to do the same sample variance covariance method, but here we are going to eliminate all the covariances, and we are only going to have the variances here. I will tell you why. So and again, we'll divide by 10. So this was the formula that we use for sample variance covariance. Now the problem here is we don't want the covariances to come into picture. So we'll write I9 to I14 equals A, and the next cell is this cell is 8. So J8 to O8. If this is true, then the value should be 1. Means the value should be given. If it is not true, then I want 0 here in after. And then I use the control shift enter, and I got the wrong value because there is some problem in the otherwise there was absolutely no reason why it should have given this kind of thing. So you try doing this in your system, and hopefully you should have only the diagonal matrix. All other matrix all other cell will have the value of 0. So what I have done is the same I have replicated here. The first one, this first entire value replicated here, here. And the second one here, what I have done, I have eliminated all this value except the diagonal matrix, which is what we are looking at. in the second one is what we are looking at the only day. So if you remember our formula for this shrinkage estimator, so what shrinkage estimator is telling you that it should be lambda, which is I'm calculating is 0.3. So lambda times this first variance covariance matrix, and 1 minus lambda times this matrix is what we want. So we'll again select 6 by 6 array. Okay, and here I will write equals this lambda into this matrix plus 1 minus again this lambda, that is 0.7, it will be into this matrix. Okay, and then I have the solution for this. So I've got this shrinkage estimator best. Let me make it like a smaller digit, so it will appeal to you. So, my God, something is working in my computer, some program. Okay. So if you can see it here, like this is much more stable. Why? Because as you can see, the correlations are very low, like 0.0066. Some of them are very low correlation. Okay, but whereas the variances are kept the same, because we believe in this shrinkage estimator variance covariance metric. We believe that the variances are not, cannot be changed because it's about individual stocks. What we are expecting is the relationship of a stock with another stock will change going forward, and that's why we have we have shrank the variance covariance by a certain factor, which is what you are seeing it here. So this is exactly how this I request you to work on your thing, because probably there is something it should not be giving like this, but looks like that something has somewhere has gone wrong, but not an issue. Even if like you don't get it, nothing to worry. You remove all the covariance system and just keep the diagonal matrix as they are. Rest all you keep 0 and multiply the first variance covariance matrix by a factor of lambda, and add along with this the second matrix, which is just the containing the diagonal matrix with the 1 minus lambda, and you get the shrinkage estimator best variance covariance. And so these are the two methods which are like which we'll be using today also and going forward also. And these are like, we'll show you why you need to tweak it. But if you again, the one question some of you asked that way, like whether this will be different, or that this is certainly different than the historical method. But the whole purpose of calculating variance covariance is to model future, and to model future you need to very closely track how the future prices or the indexes will move alongside the other individual scripts. So that's why this needs to be done. So this is what this is how we do. So this also I will share with you right now only. So let me close this, and you do it at your own pace. So now coming to the next one. Yeah. So let me share. So first, yeah. So this was share. This sheet was shared with you in the morning only, because I thought that if you start inputting the data, probably you'll be moving slowly, and if you then probably the purpose of this will be lost. So the prior to this we did in the previous session. So let me again give you some background. Otherwise, you'll not get what we are doing. So previously, what we did, we calculated envelope portfolio based on this sample variance covariance method. And what we how we calculated envelope portfolio is, we assume the constant was 0, and we also assumed the constant was 4. So on this basis, we calculated a portfolio called Z, and from Z we calculated the proportion of the X's or Y's. So what we got is Z like this, and then from Z we convert it into X. For example, X, this one will be the first one divided by the total. The second one will be the second one divided by the total of this one. So like that. So you get X and Y. So the X and Y is nothing but these are the two portfolios proportion of the four stocks. And from this X and Y, you can calculate the entire envelope. And from the envelope, you can get to know which one is efficient, which one is not, by looking at the frontier and by looking at the market risk return relationship. Now, from where I want to start is, you calculated on the basis of 0% and 4%. The question that we want to know is what will happen if we create another matrix Z from risk-free rate of 6%. So initially we created from 0% and 4%. Now we are going to create from 6%. And there is a reason why we are doing this, because you can keep it a number of ways, but as you do, you will find that there is some relationship, and which is very important. So X and Y I have just taken from the X and Y. This was done last time. This was done, X and Y was done. If you sum them up, they should sum to 1. Why? Because these are the proportion of X and Y. Now I have to calculate Z. To calculate Z, I need to calculate the risk-free rate, which is this one, and subtract from this the RFR of 6%. RFR of 6%. So if from all this I subtract 6%, is what I get here. For example, 6 minus 6 is 0, 8 minus 6 is 2, 1, this is 10, 10 minus 6 is 4. So this is RF minus 6. Now, I don't know how many of you remember this, but this is the most important, because if you don't get this, you will not get many of the things that will be doing it here right now and later on also. I showed you, I will repeat it so that you become very aware of what we are talking about. I showed you that Z can be calculated by taking the inverse of the variance covariance and multiplying that with the RF minus C. So that's how we calculated Z. But when we calculate Z, which was just the Z matrix, not the proportion of the stocks. So from there we calculated X's and Y. Here the Z I am calling it as another, like I can also call it, let me call it something else, W. So there is no confusion. Yeah. So if I call it W, so I want another optimal combination of the four stocks, which will lie on the efficient frontier and will improve on my risk return combination. So I want to calculate it in one step rather than doing it in two steps, because X and Y I showed you the previous time. I did it in 2 steps. I first calculated Z and then calculated X from there by dividing each of these value by the sum. Each of the cell by its sum, and that's how I get X and Y. So here I'm going to do all at one go. So that, because hereafter we'll use the direct formula rather than calculating first the Z and then from there X's and Y. So I write here matrix multiplication and then matrix inverse. My inverse is this one. Okay. And I already have this ER minus C. So this, is how I calculated Z previously. Now I want to do it one step. So I will just do the sum also here, and then I'm done. Sum Sorry. Yeah. So I have to do some and then 26. Okay. So I have been already divided. What we were doing previously is we were calculating individual portfolio and then dividing the individual by its sum to get it to close to one fractional one. But here I am doing it one. So I'm using again Control Shift and Enter. So there is some issue with this. So I'm accepting it, hoping that that should be fine. So let me check. Yeah, the sum is coming to one. So this is fine. So what I got was is like this one, the 4 combination of the stocks, which is stock 1 in negative proportion, stock 2 in positive proportion, stock 3 in positive proportion, and a stock D or like a stock 4 stock is very high proportion of 8 4. You should be able to answer this, that why in case of X and Y, this is important, that's why I am elaborating here. In case of X and Y, we got all positive proportion. Whereas in case of portfolio W, we have the first stock which we have to sell short. So around 60% of the stock 1 will be selling short, and then we will be utilizing this to buy some other stocks to create our portfolio. This answer, the moment you understand this answer, then you have understood portfolio management. If you haven't, then wait for some time. Probably at somewhere we'll explain this and you will understand that. But I want you to develop that thought process where you can understand that why the moment we moved from the risk-free rate of 6% from 0 to 4%, this was our 0%, this was our 4% the return. But the moment we moved to 6% risk-free rate and then we calculated the excess return, our portfolio combination has changed. The answer to this is because anyway you are getting a risk-free rate of 6%. Then why will you go for 6% stock, which is also giving you 6%? So the answer is that you can be better off by leveraging that, by selling that stock and leveraging that with the something like this is 15% return is being given by the stock. This is 4th stock. So that's actually the answer. But you'll understand this when we do it later on. So another thing which is I want you to do it later on, because probably we'll get tied up here, is this W portfolio can also be calculated just from the X and Y portfolio if W is efficient. However, if W is not efficient, then it will be a different thing. But if W is efficient, because if you remember the propositions which we talked about on the previous occasion, that if X and Y is on envelope portfolio, if you have two portfolios which are on envelope, so convex combination of that will also lead to another portfolio which will also be on the envelope. So if X and Y is efficient, then W is going to be the convex combination of that, which can be found out by a simple formula. So as of now, I'm leaving it, but if we get time, we'll do this exercise. And this is very simple. We subtract from this, and then from this, we get a ratio. We keep multiplying X's and Y's with that, and we can keep getting W. So that's not very difficult, but as of now, leave it there. Just remember that this W or any A, B, C can be created as long as they are on the same frontier. So can be created. So with that in mind, now we move to the next one. We have this variance covariance matrix, and we have the expected return, and we have the risk-free rate. Now, if I ask you the question, that how can you find the market portfolio? Because unless you know the market portfolio, you cannot have the capital market line, as you know it very well. Unless you know the market portfolio, you cannot have the capital market line, because capital market line joins the risk-free rate, is tangent from the risk-free rate to the efficient frontier. So you know what market portfolio is, or like if you have the variance covariance matrix given and expected return is given, how can you calculate market portfolio? Any idea? Okay, so what we do here is like we were calculating envelope on the basis of the assumed risk-free rate of 0, 2, 4, 6, and whatever. However, remember one thing, that we didn't know what is the constant rate, that C 0 or C equals 2%, C equals 4%, which led to the proportion of our portfolio. So the answer to this question is how to find market portfolio. If you know a risk-free rate, and with that in combination, you create your optimal portfolio. That optimal portfolio is nothing but the market portfolio. So if I have to calculate market portfolio here on the basis of this only, so what I will do is I will again do what I have done before. So this one.
Sir, is there any book for Excel or any anything like that?
Yeah. So like, Acha, you have not been told about books.
No, sir.
Okay. Okay. So the most widely used book on this modeling is Financial Modeling by Simon Benninga.
Ben Benninga.
Yeah, Simon Benninga.
Simon. Okay, sir.
Yeah, and there are a couple of other books, but Simon Benninga is most widely used across all universities in outside India also, and even in Indian some business schools. This one is very good, but there are other combination of books also. What is happening is last time when I was talking about this, some of you realized that what we are doing in Excel can also be done faster on R and Python. So the next edition of Simon Benninga is coming, not only with Excel, but also with R and Python, which is what they are working on, because the professor Simon Benninga, he had been using mostly Excel and the Visual Basic applications. So he has programmed this book mostly on the basis of Excel. But he has realized that now, because most people have switched to R and Python, so the next version is coming also with this, which is, I think, has not come in our market because I was searching for it. But you go to their website and they are saying that like it's, I think almost has come out in Western countries. So probably that will come. But like the Excel you can get anywhere. Excel is now available. So this book is there. So which talks about most of this financial modeling. So yeah, so I'm calculating the market portfolio, assuming that the risk-free rate is 5%. So here what happens is like I create the inverse of this matrix, and from here I this minus this risk-free rate, and then because this will just give me a ratio, so I need to do this sum again. So here I need to be, and then I use Control Shift and Enter. Then something matrix from inverse 83, B85, some. I don't think I've done anything different. Yeah. Oh, okay. So there is double. I should have closed it with double bracket. Okay. So I accept this correction. Oh my God. So where is the problem? Yeah. Okay. So Why is this problem? Okay, can you guys do it in your computer and see like why is it a problem? There is no problem with the formula. So can you do it in your just do it, because then we'll be better able to test whether there is some problem.
So getting the same error.
You're also getting the same error.
Yes, sir.
Oh my god. But I'm checking it differ. There is nothing wrong with the formula because this is the same method I've calculated it many times. So I'm unable to understand where is the issue. Maybe there is something is in file only, like the Excel. Can you copy this in another sheet and then see if there is any issue with this? Of course, we can. Like I know how I can do it in another way, but I want it to be done in one step. That's why we have to wait it this. So just see, or like let me see if I can do it alternatively. But you try it other way. So what I will do here it is. So I got the answer alternative way, but I'm surprised why it's like this is avoiding. Why this is the same way I am doing it here and it's working. So that's sometimes like, anyway, just bear with me. Maybe there is some problem with the file, because it's possible that some virus is there which is working on affecting like stopping us. Because see, what I did is, so the risk-free return, from the expected return, I calculated the excess return over the risk-free rate. Risk-free is 5. So 5 I subtracted from here, so I got another row. And because so I calculated matrix Z, which is inverse of the variance covariance matrix into the ER minus C, which is what we have been doing since the beginning. So once I get this, then the value of this is the first one divided by its sum. The value of the second is the second divided by its sum. Value of the third is third divided by its sum, and value of the fourth is this one divided by the whole thing. So this is how the proportion of stocks I have got. And if you can see, all stocks are in positive combination. So what is happening here is, like, we have got the stock 1, stock 2, stock 3, and stock 4. So for example, stock 1 is 3%, stock 2 is 20%, stock 3 is 6%, and stock D is 70%. So this becomes your market portfolio. Why? Because this is efficient. This will be on efficient frontier, and because you have calculated this on the basis of risk-free return, so this becomes your market portfolio. So this is your market portfolio, which should have come here exactly. But I'm still at puzzle why. What on earth should stop it from getting this value? Because I can't see any error in the messages. I can see it minutely also, but I'm not seeing any. Anyway, so forget that. No issue, because anyway we calculated market. So actually that's why I always emphasize on doing it in like a step by step. So step by what we calculated Z matrix, and then we calculated X of the market portfolio. So call it market portfolio. So market portfolio is 3% of you can make it percentage also if you want. So 3.13% of stock 1, 20% stock 2, 6%, little over 6% of stock 3, and very high percentage of stock 4 or stock D. So this is how you get the market portfolio. So if you combine your risk rate with the market portfolio, you are like on the capital market line, which is what capital market line tells you, that any combination of the risk rate and market portfolio gives you the highest risk adjusted return, which is what capital market line is all about. Now we go and calculate the securities market line. So I want some of you to answer me this question before I proceed, that what is the difference between capital market line and securities market line? Because unless you understand this, there is no point doing it, because like you will keep on doing modeling, and finally one day you will fail to understand that whether you're doing CML or the SML. So if any one of you knows it, please tell me, or like I will explain. Yeah, so okay, will any one of you venture to say something about CML and SML? Okay, not a problem, not a problem. So let me explain like what I want to say about CML and SML. So if you see capital market line, what you are saying is you are looking at your optimal portfolio, which is giving you the relationship between the risk-free rate and relationship between your portfolio in terms of the overall risk, which is a standard deviation. So on capital market line, you there is a line that plots the risk return relationship between your portfolio and the risk free rate in terms of the standard deviation. Whereas in case of securities market line, the line shows the individual betas of the stocks vis-a-vis the whole market. So like if you see the on securities market line, if you see beta equals 1, so you can be rest assured that you have the market portfolio. If you see the beta more than 1, so you can have a portfolio, or you can have a stock which has a higher beta higher than that. So SML plots return and beta online, whereas CML plots return and the standard deviation. So these are the two differences. So we go and see this how do we calculate securities market line. So if you can see, I have the monthly return of the S&P 500 as well as some, how many, 30, yeah, some 30 so some 30 stocks comprising of Dow Jones indexes. So we have the 30 stocks comprising of Dow Jones indexes as well as the S&P 500 indexes. So these are the price of the individual stocks like Alcoa, American International Group, American Express, Boeing, Citigroup, Caterpillar, and DuPont, and all that. Now this price we convert into return, because ultimately, unless we have the return and the variance covariance, we can't work on the relationship that we want to establish. So this average return, as you know, is just the average of the entire this S&P 500. Similarly, average of everything is very easy. But if you have to calculate beta, how do you calculate beta? So beta is nothing but beta is basically slope. So sorry, slope. Beta is slope of the x's and the y's. But here what happened, I am calculating beta of S&P. So that should be 1 only. But anyway, I will do this. So let me calculate this first. First y's, and then I'm calculating this on itself. So you should not be surprised, and you should not be saying that it's a madness, because this is how we do. So this is what we did, and then the alpha is nothing but the intercept. So again, intercept will and then okay, and finally R square. So R square so R square. Oh, sorry. I got this. Now, this was not important because this was only to expected. So let's calculate this for Alcoa. So if I calculate beta for Alcoa, so this becomes, so my y becomes Alcoa. So Alcoa is nothing but C in column C, C92 to C152. This becomes my y. Then I do for index, which is B92 to B152 Then I'm done. So this is the beta I've got. Similarly, I will calculate alpha for this. I calculate alpha for this. Again, I have to use so I get alpha for this, and then finally r square. I get r square of so I got r square of close to 45.53%, which is okay, means not that bad. Similarly, I do we'll have to do this for all others, or all others are calculated, but let's do for this one so that quickly. If I take a copy of this, I got a very low r square. Again, if here I calculate for this, two, then B92, B152. Then I got this slope for this, and then if I have to use intercept, so I got the alpha, negative alpha, and then finally I calculate r square for this regression. So I've got the r square also, and as you can see, r square is good here. So basically, I've got a data set of all the average return of all 30 stocks, the beta of all the 30 stocks, alpha of all the 30 stocks, and r square of all the 30 stocks. So you can see r square varies from 45% to 32% in some cases, and in some cases 81, like as low as 8.1%. So you need to see as how, like, what is your r square to understand that what is the extent of the relationship between the variable x and y, and how much x can explain y. So with this in mind, what is, like, we have the stock return and we have their average return, and where their beta and alpha is calculated. So this is the first way of doing the regression for a stock about which we want to draw a security market law. In second situation, we calculate a second pass regression where we regress the average return of the stocks over its beta. Because if you see, securities market line is the market line of the betas of the individual stock, the line which can show the relationship between different return and different betas of individual stocks. So what I do is I create, like here, I create all the stocks here with the 30 stocks, and I have taken their average return from the figure at the top only. So I have taken the average return, which is, this is in fraction, not in percentage. So this average return, and this is beta, and this is alpha. Now, in order to know the securities market line, we have to calculate the second regression. So for second regression, we require the intercept, which is the beta. We got the intercept, and then similarly we have to use the slope function to calculate the sorry. So I selected this. We calculated slope. Slope also is very low. And then finally we calculate the R square. So as you can see, we have got the intercept, slope, and R square. See, this R square of low should tell you very clearly, and you should be convinced that if the R square is so low, so what it means is, like, your regression is not very reliable, because it's a very low. It's only explaining a very little fraction of the return of the portfolio on the benchmark. So now, like, I leave this on to you. So if you do t-test of these both intercept and the t-test of the slope, both of them should come out very low, and that low value should give you less confidence in the figure. So what this is saying, your security market line is nothing but 0.0026 plus, in this case it's going to be minus because beta is minus 0.00121 x, and this is what your securities market line is actually. And of course you can write here the epsilon term, which is what we sometimes do, because we know that the actual return, predicted return, will be different from the real return. So this is your security market line. But because the R square is so low, actually ideally it should be 100, because if it is really the securities market line, it should be able to explain all the variations in the Y portfolio with the help of the independent variable, which is the market. So so this, of course, we use the 30 in stocks Dow Jones with the S&P 500, which is a broader market index, and S&P is a good proxy for market, but still the figure that we got. So there can be a number of reasons why we have failed to get a very good very good uh, the estimate of the securities market line. But our process is good. The best part is we have done it the right way. We first have to calculate the intercept and the average return, the intercept and slope of each of the individual stocks comprising of the index. And then by doing this, we can have this for 10 stocks, 20 stocks, and 30 stocks. In the second stage, what we do, the mean return of each of these stocks will regress on its beta so calculated, and then we'll have a second regression equation. And if with that equation your R square is 100%, then you can be confident that this is the securities market line, which is what you're drawing. And then your statistics should also tell that the factors that you have got for the value that you have got for the intercept or the beta, they are robust. So the question that you should be asking is, why are results so bad? So if the capital asset pricing model doesn't hold, then the securities market line will not be accurate. So if for the accuracy of this SML, it's important that the CAPM should hold. But of late, there has been more criticism of the capital asset pricing model, and those criticism are that like the capital asset pricing model, if you recall, is what the market portfolio is comprising of all the risky assets in the universe. Whereas in our case, what we do is we take the broader market index as a proxy for the whole universe of risky asset, which cannot be true. Should be true, but cannot be true if like the entire universe of risky assets is to be included in the portfolio. So sometimes CAPM doesn't hold, but yes, CAPM does hold in case of portfolio, may not hold for individual stocks. The other problem why our SML came out to be so bad is the market portfolio which we create from, as you have seen, we have created market portfolio, and we have created market portfolio from the efficient frontier from the matrix Z, which is nothing but the inverse of the variance covariance matrix multiplied with the excess return of the portfolio over benchmark return or the risk-free rate of return. But if market restricts short sales, so you are deviating from the ideal combination, and the result could be that the proportion of the benchmark itself is problematic. And
So,
yeah.
sir, while using this alpha, beta, and R square, why didn't we use the tool with Excel which is available that gives instant results?
No. What you're saying?
Instead of calculating it by hand, why didn't we use the there is I don't know, I did that. There was a tool in Excel where you can use the linear regression.
Okay, yeah, I got you. Yeah. So the reason why we are not using it, because we are not looking at those lines. We had to use all those parameters together, like the statistics, all those statistics and our table. So I could have used those formula. But here I am just telling you that how to use the first pass regression and second pass regression, and what are the ingredients required. So we just needed these three things: intercept, slope, and R square. However, if I really needed to calculate the regression for this, any particular x's and y, I could have used any other, and why use it at all? Because Excel still restricts you in terms of throwing lots of information. So I could have used any other model for that. So that's absolutely no bar. Whichever you want to line estimate or whatever, you can use all those things. But the bottom line is, whatever formula you use, ultimately you are going to get the same value. Value is not going to be different. That's what we are concerned here. That
so we can use the Excel tool, right?
Yeah, you can use anything, but if ultimate thing will be your result will not vary whichever tool you're using. So
Okay,
that's
sir.
what, yeah. So that's what we are talking here. So like when we are talking about how we calculate the securities market line given a portfolio and the market. So this is how we do. And then in our case, because it hasn't held, so we are talking about that. So and the other reason is individuals may not have the same homogeneous expectations. So if individuals have not the same expectations, so they will have a different combination of that. As a result, the pricing and the return in market will vary. And this I told you that CAPM may hold the capital asset pricing may hold for portfolio consisting of large numbers, but it may not hold for individual assets, and that's why then SML also may be a problem. And this is anyway criticism of CAPM, that our set of risky assets may not be enough, because we have taken just the 30 stocks to draw a capital securities market line. However, the S&P 500 index may be driven by the return of oil, which is not included here, may be driven by return of commodity, which could be gold also, which could be anything. So risky assets should be, universe of assets should be large. And then of course, if market portfolio is not efficient, so in that case the S&P 500 may not itself be efficient. That's why the SML is not efficient. And in this case, the most important thing is what, and why I did it this way is the slope that we got is negative. Normally, you should not get a negative slope like this, because if you're getting negative slope, what it means is your returns are going to be just the negative, whichever stock you are holding in portfolio, which is not the case, unless like the beta of that individual stock is negative, and then your return is that's a different. But the SML slope itself is negative, which is somewhere very problematic. Just because we are using the wrong set of data, but it may not be the case if we use a better set of data. So this is how we use. But just to drive home you the point, what we are going to do, we are going to pick the right set of data, and do this exercise again to show you how the SML can be explained if your benchmark is the right benchmark and the returns are right. So here we have the variance covariance matrix for these same stocks, as well as their here we have the yeah. So here the same variance covariance matrix for this these 30 stocks. Let me see how many stocks we have. Yeah. So we have used the same 30 stocks, and then we have used a different benchmark. So we have used a different benchmark. Now, the if you are asked to draw security market line from this information, and if you somehow turn out to if your result somehow turns out to be the very robust, then you can be assured that the SML holds in this particular case. So would you like to do this alongside me, so that like you can see that what is the result? Why don't you try it? Because the way we tried for the previous case, why don't you try this? Just try, and we'll see if your results are coming, because then you can be assured that yes, the results are good. This won't take much, because you can just copy the cells and then I will copy this and paste it across all. These two are not required. Okay. So I've got the average return of all these stocks. Now I have to calculate beta. So I'll calculate slope. Then I need the y's. I've calculated beta also for these stocks. Now I calculate alpha. So alpha is nothing but the intercept.
Excuse me, sir. Could you please show the beta once again?
Beta. Okay. Good that you asked me. So it shows to me that you are live. So what I calculated beta is I have only y is changing, but x remains the same. So I did this $B $294 to $B $353, which is entire the mysterious portfolios benchmark portfolio of this column B. So once I have done it for one stock, I've done it for all these stocks. So
Yes, sir.
yeah. So this is what I did. So this is what I. So you'll see one thing is very common. So same thing I will do for alpha. So yeah. So here actually. We'll again select this. Yeah. And then $B. Sorry. $4. 353, because this is where my all data set is. So I got the, and then I copy this and I paste it in all the, so I get the Excel alpha for okay. Here also let me calculate alpha intercept. Do you see any problem in this calculation? What we did till now? Can you spot any error in this one?
No error, sir.
Okay, there is one, which is what happens when you become used to practicing it. Then there I will show you because I just realized, I looked at it and then I realized that there is small. But anyway, let me first do it and then. See, this is like I was calculating mysterious portfolio. So this cannot be C294. This is also, oh my God, this got entirely shifted. See, this is a complete error because you know why? This whole is calculated in a wrong way. If you're calculating this is the index market portfolio. So this has to be B294 to B353. And this is where sometimes there is a problem. And this is how you get. So you get, because if you have the index, if your market portfolio, there is no way why beta should not be equal to 1. Now if I copy this and paste it in this entire one, then I will see whether my result is changing. Just you check for yourself. So I think it's changing slightly. Yeah. So then alpha is this one, and this is calculated rightly. So alpha is calculated rightly because this is rightly. Okay. So anyway, we are done for this. Now R square, coming to R square. So again, R square, you need to RSQ the C 294 353 I calculate R square, and then I will copy this and I will paste this so that we don't have to do this. So we got the R square also for individual stocks. Now, so this is what we call it first pass regression. So if I have to write it here, so I need to call it first pass regression. Why? Because I'm regressing the individual portfolio return on the benchmark return. That's why I'm doing this a small calculation of. Otherwise, I could have used the advanced estimation of line, where I could have shown the line also, and I could have like seen all this ANOVA table also. But we are at this moment only concerned with the seeing the parameters of the regression. So we have got the regression. Now at the second level, what we have to do is regress all this mean return on its beta. So we need the beta for all these stocks. So copy this. Already, since they are there, so there is no need. So what is the mean return? So the mean return is this, and the beta is this. So we have to the second regression. We have to use this only. So let's see. So intercept, and intercept of what? So our y's are this. This one. C2H to F83. Then this we have to regress it on beta, which is here. If you do it, we get the beta for second regression. We got intercept, and then we have to use for slope. So again, for slope, we'll use the y, which is the average return with 30 stocks. We got beta also. We got our beta also. Now the most important thing is the R square. Can you see the difference? Can you see something surprisingly different? The answer that we got, the R squared is 100%. Means 100% of the variation of individual return is being explained by the return of the index. So you have got a securities market line, which is almost perfect. Perfect in the sense that it gives you the line where you can have the individual stocks return regressed on its beta. So it's possible that you can get a relationship like this, and if you get a relationship like this, then what it means is your regression is robust and you can have the trust in this. Similar way, since R square is anyway 1, but still if you want to calculate the t values for this, you can do, and then have trust in your model. So securities market line is basically a relationship between the individual returns, the return of individual stocks vis-a-vis the market and the risk that the stocks have, which is what we call it beta. So the relationship with beta and the return is what is depicted in this line. Now we go and talk about black letterman approach to portfolio management, which is the most widely used portfolio tools in the market. But and not only most widely, but most acclaimed, because there is a theory behind this. And whenever they came up with this solution, there were lots of appreciation for this model, because this is a very like path-breaking model, in the sense that till now people were just trusting on their own understanding of the market, their own understanding of the variance, covariance, or correlation between different stocks. So as you can see, this relationship is, once you have a risk-free rate known and the market portfolio calculated on the basis of this risk-free rate, and if you draw a tangent, so you have got the efficient frontier. So you can have the combination of this and that. Now, when we talk about optimization, our goal is to maximize this only, which is the expected the excess return of our portfolio over the risk that the portfolio has. If some of you have been told about Sharpe ratio, this is nothing but Sharpe ratio, and why it is advisable to be on the efficient frontier, because at nowhere, for example, if you be here, so on risk return relationship, here you will not be as good as if you are here on this tangent line. You will always be better in terms of risk return combination than on this this frontier. So though this is an efficient frontier, but this line gives you the best optimal combination of risk and return. Now, the whole goal of ours in any portfolio management tools is to maximize this only, which is what we call theta. So theta, which is Sharpe ratio, equals the excess return of the portfolio over the risk return. The excess return of portfolio, excess of portfolio return over the risk-free rate, and divided by the risk of the portfolio, which is the sigma p. So once you do this, you get the Sharpe ratio. So in any optimization, our goal is to maximize this one. So now let's see. So we have this variance covariance matrix, which is not different from the previous variance covariance matrix. And we are given the mean return of the portfolio, like comprising of the 4 stocks, as 8, 9, 10, and 11%. We have the risk-free rate of 3%, and we have to optimize this portfolio without short sell restriction. So this is there is no constraint. This is unconstrained optimization. Now, like, why we have selected this naive portfolio is because we want this to be sum to 1. So let me sum it. So this has sum to 1, but we don't know what this combination should be, because this could be anything. This could be anything, 0.3, 0.4, 0.6, 0.9 minus something like that. So let us attempt this. So if you have to calculate portfolio mean out of this, so what you do a matrix multiplication, and because you have this into a column matrix and this into a column matrix, so you have to use transpose of this. So transpose and this, then mean of this. We got portfolio mean of 9.5%. Now if I have to get portfolio sigma, how do I get sigma? Sigma is nothing but the standard deviation, which is the square root of the variance. So can any one of you help me calculate portfolio sigma? Because we have this portfolio and we have this variance covariance matrix, we have this expected return. Does any one of you have any idea how we calculate portfolio sigma on the basis of portfolio proportion? Yes. Can anyone recall this? Because this was in the very beginning we did this test. No. So like maybe you have not memorized the formula. So okay. So I will have to do matrix multiplication, of course. And then again matrix multiplication, because I'm going to use two matrices. Then I have to use transpose of this with this, and then let me check. Transpose of this will give me row matrix, and then variance covariance is as this. So this will give me one set of matrix of 1 into 4 and 4 into 4 is 1 into 4 and 4 into 1 will be 1 into 1. So I'm fine with this. So this will give me variance. So this is variance of the portfolio, not the square root. So I will have to change this to square root. And this. So this is my portfolio sigma. Now if I have to calculate the theta, which is a Sharper ratio, so what my mean return minus this return, and then this I will divide by the portfolio sigma, which is this one. So this my I got my theta of 18.38%. Now if I'm talking about portfolio optimization, I have to maximize this in such a way that this become higher and I get the optimal portfolio. So I because we will have couple of minutes only left, and maybe you'll have. Do you have class hereafter?
Yes, sir.
Okay, so I will stop here because this is interesting, and I don't want in hurry that you miss. Now, of course, this is very easy and can be done in 30 seconds, so you can move. But let's not do it in hurry. We'll start from here because I will do the optimization in such a way that the optimizer gives you different value, and this gets maximized without affecting any other parameters, and like again ensuring that the other parameters are fine. So thank you. We'll start from here the next time, and then we will do with the constraint optimization without with short cells, without short cells, and then finally the black letterman portfolio will get. So maybe we'll do it the next time, but I've showed you how we can do this using solver, and even without solver we can do this. So okay, thank you very much, and you carry on with this because there will be someone waiting. So thank you very much.
Thank you, sir.